Hi there, and thank you for tuning into today's episode of Only Finance. I'm thrilled to have you here as we embark on this exciting journey together. This podcast is all about breaking down the world of finance in a way that's simple, engaging, and practical. Whether you're just starting out, trying to make sense of your budget, or curious about growing your wealth, you've come to the right place. So, grab a cup of coffee, get comfortable, and let's talk finance. My AI friends will take over now.
All right, so today we're going to be doing a deep dive into resilient portfolios using alternative investments.
Sounds good.
So this should be pretty interesting, I think, for a lot of people, especially in this market, trying to, find different ways to protect their investments.
Exactly.
So where should we start with this?
Well, I think the main reason that people are starting to turn to alternative investments is that stocks and bonds have shown themselves to be a little bit vulnerable recently. And
Yeah.
I think people are starting to look for things that can give their portfolios a little more resilience.
Yeah, it's like, building a house,
Yeah.
You got to have a good foundation. You got to have those extra support beams if you're in an earthquake zone or something.
Absolutely. It's all about diversification
Yeah.
and not putting all your eggs in one basket.
Yeah, and I think, speaking of not putting all your eggs in one basket, when we talk about alternatives, there's so many different options, It's like this huge buffet.
Huge buffet
Yeah.
of different things.
Exactly.
So where should we start with all that?
Let's start with the one that probably most people have at least some passing familiarity with, which is real estate.
Okay, sure.
Real estate is a really interesting asset class because it's something that you can see and touch.
Right. Yeah.
It's not this ephemeral thing that exists on a computer screen, and it tends to appreciate over time. It can provide a steady income stream through rentals.
Yeah. I mean, real estate, you always hear it's a safe haven asset class,
Sure.
And certainly, in 2008,
Right.
you saw that, a lot of people, their portfolios were decimated and real estate kind of held its ground.
It did, and even in some cases appreciated.
Right. Yeah.
And so that's one of the reasons that people turn to it in times of uncertainty.
So, obviously, buying a property is one way to invest in real estate, but there's
Sure.
other ways too, right?
Yeah, absolutely.
Like how else can we tap into that?
Yeah.
So one of the more popular ways these days are REITs,
Okay.
real estate investment trusts. And these are basically like baskets of different properties that you can buy into.
Okay, so I don't have to actually go and buy a house or a building.
You don't have to go be a landlord. You can just buy into a REIT and participate in the appreciation of the underlying real estate.
Okay, I like that.
Yeah.
A mini real estate empire without having to actually,
Exactly.
do all the grunt work.
And you get the diversification benefit too, because a REIT will typically hold lots of different types of properties.
Okay, so what about, besides real estate, what else is on this buffet of alternative investments?
So another big one is commodities.
Okay.
And these are the things that make the world go round. They're the raw materials like gold and silver and oil and agricultural products.
Okay.
These things have intrinsic value because they're used to produce everything else.
Right.
And one of the big reasons people turn to commodities is because they're a hedge against inflation.
Okay. Yeah, because as the dollar
Exactly.
fluctuates and, goes down in value, these things kind of.
These things tend to hold their value.
Right. Yeah.
And sometimes even increase in value.
And that makes sense. I mean, especially something like gold, that's
Yeah.
always been seen as,
Safe haven.
right, a safe haven asset.
Yeah, exactly. And we saw that play out in early 2020 when the pandemic hit. The markets went haywire.
Oh, yeah.
And gold surged.
Everybody was buying gold.
People were flocking to gold because they wanted something that was going to hold its value when everything else seemed uncertain.
Yeah. So it's like that, I don't know what the word is, but like that,
Yeah.
that real world
Tangible asset.
tangible asset, right? That's what it is.
Yeah.
Okay. So commodities. Okay. We got real estate. We got commodities. What's the next course on this alternative investment meal?
So the next one is a little bit more exotic.
Yeah.
This is private equity.
Ooh, private equity.
Private equity.
Yeah.
Now, this is where you're investing directly in a company or a startup that's not publicly traded.
Okay. So instead of just, buying shares,
Exactly.
some in the stock market.
You're getting in on the ground floor
Yeah. Okay.
and you're helping to fuel the growth of that business.
So that sounds exciting, but also,
It can be.
risky.
It is risky.
Is that something that the average investor can even
It's traditionally been the domain of high net worth individuals,
Okay.
but now we're seeing crowdfunding platforms emerge that are allowing
Oh, really?
everyday investors to get in on the action.
Okay, so that's kind of democratizing
It is
access to this
It is.
asset class.
Yeah.
Okay, but so how does private equity, contribute to this idea of a resilient portfolio?
So the interesting thing about private equity is that it's not tied to the daily fluctuations of the stock market.
Okay.
So your investment is not going up and down every day based on what the market's doing.
So it's more of a long-term play.
It is a long-term play.
Okay.
And so it's a different kind of resilience.
Okay.
It's less about riding the waves and more about building a solid foundation.
Okay, all right. So we got real estate, we got commodities, we got private equity. What else? What else is on this menu of alternatives?
So the next one is the one that everybody's talking about, cryptocurrency.
Okay.
This is Bitcoin, Ethereum, all the different digital assets that are out there.
Yeah. I mean, I see the headlines, I see the price charts going up and down. It's a wild world.
It's a very volatile asset class.
Yeah.
But it also has the potential for very high returns.
Right.
I mean, if you look at Bitcoin, for example.
Yeah.
It's gone from being this niche thing that nobody understood to a mainstream asset class in a very short period of time.
Okay. So it's kind of proven that it's here to stay.
It has.
Yeah.
It has. And a lot of people are starting to see it as a legitimate portfolio diversifier.
Okay. But, even if it is here to stay, I mean, it's still so volatile. How do you justify putting it into a resilient portfolio when it goes up and down so much?
Well, I think the key with cryptocurrency is to remember that it's still a very young asset class.
Okay.
It's going to be volatile.
Right.
But the potential rewards are there. And I think that as it matures, we'll see that volatility start to come down.
Okay. So, the idea is that even though it is volatile, that potential upside outweighs that volatility?
Exactly.
Yeah.
And I think it's also important to remember that diversification is key even within the world of crypto.
So you're not saying just, put all your money in Bitcoin or something?
No, spread it around.
Right.
Don't put all your eggs in one basket.
Same principle.
Same principle.
Yeah.
Applies across the board.
Yeah. Okay. All right. So we've got real estate, we've got commodities, we've got private equity, we've got cryptocurrency. This is quite the buffet.
It is.
What's the last item on this menu?
So the last one, and this is one that is a little bit more complex,
Okay.
is hedge funds and managed futures.
Oh, yeah. Hedge funds. I mean, that's always sounded so, like Wall Street.
Yes. Exclusive.
Exclusive. Yeah.
Yeah.
Fancy suits and all that. So what are hedge funds and managed futures?
So these are basically actively managed funds that are run by professionals who are using sophisticated strategies to try to generate positive returns.
Right.
Regardless of what the market is doing.
So no matter what happens.
No matter what happens, they're trying to make money.
Wow.
Now, these can be very complex.
Okay.
They often use leverage. They use derivatives.
Leverage and derivatives. I'm going to need a little more explanation on that.
So leverage is basically where you're borrowing money to amplify your returns.
Okay.
So let's say you have $10,000 to invest.
Okay.
And you use leverage to borrow another $10,000.
Right.
Now you have $20,000 invested.
Okay.
If your investment goes up 10%, you've made $2,000 instead of $1,000.
I see. So you're kind of magnifying your...
You're magnifying your returns, but you're also magnifying your losses.
Oh, okay. So it's a double-edged sword.
It is a double-edged sword.
Got it.
And then derivatives are financial contracts that derive their value from an underlying asset.
Okay.
So, for example, you could have a derivative that's based on the price of gold.
Okay.
And if the price of gold goes up,
right,
the value of your derivative goes up.
Okay.
And these can be used to hedge against risk, or they can be used to speculate on future price movements.
So these are definitely not for, somebody who's just starting out.
No, these are for sophisticated investors who understand how these things work.
Got it.
Okay.
So, all right, so that's quite a spread. I mean, we've got real estate, commodities, private equity, cryptocurrency, hedge funds, and managed futures. I'm starting to see how this buffet can help build a resilient portfolio. But how do all these pieces actually fit together?
That is the question, isn't it?
It is. Yes.
How do we take all these different ingredients and put them together in a way that makes sense for our individual goals and risk tolerance?
Right, because I'm guessing it's more nuanced than just picking a couple of these and just,
Yeah, you can't just throw a dart at a board and say, I'm going to invest in that.
Right, exactly. Okay, so let's unpack how these alternative investments actually contribute to this idea of a resilient portfolio.
Let's do it.
Okay, so we've laid out this incredible, spread of alternative investments, but it's not just about picking and choosing randomly, right?
No, it's not. It's about understanding how these different asset classes can work together
Okay.
to create a harmonious balance in your portfolio.
So it's like composing a symphony, not just assembling an orchestra.
Exactly. You need to understand how each instrument contributes to the overall sound.
Right. Okay, so let's start with the cornerstone of risk management diversification. We know that stocks and bonds can kind of move in tandem. So how can these alternatives help break that correlation?
Well, the beauty of alternative investments is that they often behave differently than traditional assets.
Okay.
Real estate, for example, tends to be more stable,
Right.
while commodities like gold can act as a safe haven during market turmoil.
Right. Yeah, and we saw that in 2020.
Exactly.
When the pandemic hit, everybody was buying gold.
Exactly.
So it's about creating that web of interconnected safety nets so that if one part of the portfolio weakens, the other parts can pick up the slack.
That's a great way to put it. It's not about eliminating risk entirely.
Right.
It's about spreading it out intelligently.
Okay, so let's delve a little deeper, into specific scenarios. Let's say, for example, that I'm really concerned about inflation, eroding my purchasing power over time. Which alternatives would I lean towards in that situation?
Well, inflation is a big concern for a lot of investors.
Yeah.
And in that scenario, you'd want to look at assets that have historically held their value during periods of inflation.
Okay.
So things like
Commodities, okay.
precious metals, gold, silver.
Right, because, as the dollar goes down in value, those tend to
Exactly. They tend to retain their worth.
hold their worth. Yeah.
Real estate is another one that could be a good hedge against inflation.
Oh, okay, yeah, because as prices go up,
As prices go up, real estate values tend to follow.
tend to follow. Right. Okay, so instead of just sitting on cash that's losing value, you're strategically putting a portion of your portfolio into assets that might appreciate alongside inflation.
Exactly. You're staying ahead of the curve.
Okay, I like that. All right, so let's say, different scenario. I'm not so worried about inflation, but I'm really concerned about market volatility. I don't want to be glued to my phone every day watching my portfolio go up and down. Which alternatives might give me a little more peace of mind in that case?
So if you're concerned about volatility, you want to look for investments that aren't as correlated with the stock market.
Okay.
And one of the best options for that is private equity.
Private equity. Okay, yeah, because we were saying that's more of a long-term play.
Exactly. It's not subject to those daily fluctuations.
Right.
You're investing in the underlying businesses
Right.
and you're letting them grow over time.
So it's like having a portion of your portfolio that's anchored to something more stable, less reactive to those day-to-day market swings.
Precisely. And that can provide a lot of peace of mind for investors who don't want to be on that emotional roller coaster.
Right. Yeah, I mean, they always say time in the market is better than timing the market.
Absolutely.
So if you're in it for the long haul, those short-term fluctuations shouldn't matter as much.
Exactly.
Okay, so I'm starting to see how this all fits together. We're not just chasing returns. We're strategically allocating our investments to address specific risks and align with, our own personal comfort levels. But how do we actually determine those allocations? Is there like a magic formula or something?
There's no magic formula, unfortunately.
Oh, okay.
It really depends on your individual circumstances,
Okay.
your risk tolerance, your investment goals, your time horizon.
Got it.
But there are some general guidelines that can help you get started.
All right, let's talk guidelines. What are some of those key principles to keep in mind when we're talking about allocating to alternative investments?
Well, first and foremost, I would say start small.
Okay.
You don't have to go all in on alternative investments right away. Start with a small percentage of your portfolio, maybe 5% or 10%.
Okay, so dip your toes in the water before you jump in the deep end.
Exactly. And as you gain experience and confidence, you can gradually increase your allocation.
Okay, and that makes sense, especially if you're new to this whole world of alternatives.
Absolutely.
Okay, so start small. What else?
Diversify even within your alternative allocation.
Okay, so you're saying don't put all your eggs in one basket, even within the world of alternatives.
Exactly. So, for example, if you're investing in real estate,
Right.
you don't want to put all your money into one property.
Okay.
You want to spread it around, maybe invest in some REITs,
Okay.
maybe buy a rental property,
Right.
maybe invest in a real estate crowdfunding platform.
So create those mini portfolios within the larger portfolio.
Exactly.
Okay, I like that. So spread it out even within alternatives. What else?
Rebalance regularly.
Rebalance. So what does that mean?
So as market conditions change, the value of your different asset classes will fluctuate,
Okay.
and that can throw your portfolio out of balance. So rebalancing is the process of periodically selling some of your outperforming assets and reinvesting those proceeds into your underperforming assets.
Okay, so it's like pruning a garden. You're trimming back the overgrown branches and nurturing the areas that need a little extra attention.
That's a beautiful analogy.
Okay, so rebalance, make sure that the portfolio is still aligned with, my risk tolerance and all that.
Yeah, exactly.
Okay, cool. I'm really starting to grasp, the nuances of this and how it all fits together. But before we dive into, specific strategies and platforms, I'm curious, are there any downsides to alternative investments? We've talked about the good stuff, but what about the bad stuff?
Well, that's a great question, and it's an important one to ask because there are definitely potential drawbacks that investors need to be aware of.
Okay, well, let's talk about those potential downsides because I want to make sure that, we're going into this with our eyes wide open. Okay, so let's talk about those potential downsides.
Yeah.
What are some of the things that investors should be aware of when they're thinking about alternative investments?
Yeah, one of the biggest ones is liquidity.
Okay, liquidity. So what does that mean exactly?
So with traditional investments, like stocks, you can buy and sell them very quickly.
Right, on the stock market.
Yeah, exactly.
But with some alternative investments, like private equity or real estate, it's not so easy to cash out quickly.
It's not you're locked in for a longer period of time.
Okay, so you need to be prepared to hold these investments for, potentially years.
Potentially years, yeah.
Not something you can just, buy today and sell tomorrow.
Not a quick trade.
Okay, so that's liquidity. What else?
Complexity.
Okay.
Some alternative investments can be very complex.
Right.
Especially things like hedge funds.
Yeah, hedge funds, we're talking about those derivatives and all those things.
Exactly. Those are strategies that are very difficult for the average investor to understand.
Yeah, definitely not something you want to just, jump into without doing your research.
You really need to know what you're getting into.
Okay, so liquidity, complexity, what else?
Fees.
Fees, okay.
Alternative investments often come with higher fees than traditional investment.
Okay. Well, why is that?
Well, because they're often actively managed.
Okay.
So you're paying for the expertise of the fund manager.
So it's not just, a simple index fund or something.
Right. It's much more hands-on.
Okay. So you're paying for that active management.
Exactly.
Okay. Liquidity, complexity, fees, anything else?
Be wary of the hype.
Okay.
There's always a new hot investment.
Oh, yeah.
Especially in the world of alternatives.
Right. We've seen that with crypto.
Crypto is a perfect example.
Yeah. Everybody was talking about it. Prices were going through the roof.
Exactly.
Yeah.
And it's easy to get caught up in that excitement.
Yeah. You don't want to FOMO into something.
You don't want to FOMO.
Right. Exactly.
So do your research.
Don't just blindly follow the herd.
Yeah.
Exactly. A resilient portfolio is built on a foundation of solid research and careful consideration.
I like that it's not about chasing those, quick riches. It's about building something solid.
It's about building a strong foundation.
Okay, so as we wrap up this deep dive, we've covered a lot of ground here. We've talked about, all these different alternative investments, how they can contribute to a resilient portfolio. We've talked about some of the potential downsides. What's the most valuable piece of advice that you would leave our listeners with when it comes to navigating this world of alternative investments?
I would say knowledge is power.
Knowledge is power. Yeah.
The more you understand about these different asset classes, the better equipped you'll be to make informed decisions.
Okay, so do your research, understand what you're investing in?
Exactly. And don't be afraid to ask for help.
Right. If you need to talk to a financial advisor or something.
Absolutely.
Yeah. Okay, great advice. And it's been a fascinating journey, exploring this world of alternative investments with you.
It has been. Thank you so much for sharing your insights and expertise.
My pleasure.
So for our listener out there, remember, investing is a marathon, not a sprint.
That's right.
So pace yourself, stay informed, and enjoy the journey.
Enjoy the journey.
Okay, great advice. Thanks again for joining us on the deep dive.
Thanks for having me.
Until next time, keep seeking knowledge, keep asking questions, and keep pushing the boundaries of what's possible.